China's economy is the second largest in the world at $18 trillion, but beneath the surface, there's $50 trillion in hidden debt. Local governments are insolvent. The real estate sector that represents 30% of GDP is in free fall. Youth unemployment is so bad they stopped publishing the data. And the demographic collapse means the working-age population is shrinking by 5 million per year. This isn't a slowdown. This is terminal structural failure disguised as stability. Right now, China has more debt than the United States, Europe, and Japan combined when measured as a percentage of GDP. Total debt to GDP is over 300%. That includes government, corporate, and household debt. But the real number is higher because local government financing vehicles hide trillions in off-balance sheet liabilities. The Bank for International Settlements published data in October 2024 showing China's total credit to GDP gap, the measure of excessive credit growth, is at plus 30 percentage points. Anything above 10 is considered dangerous. 30 is crisis territory, and it's been climbing for 15 years. The debt accumulation accelerated massively after 2008, the exact period when China's growth model shifted from exports to infrastructure investment and real estate speculation. The probability of this debt being sustainable given slowing growth and demographic decline? 0%. This is the pattern of Japan in 1990, but worse. Japan had debt crisis with an aging population and stagnant growth, but Japan was rich when it happened. Per capita GDP was $30,000. China's per capita is $12,000. They're getting old before getting rich. And the debt bomb is 3 times larger relative to economy size. Michael Pettis, economics professor at Peking University, stated in September 2024, China's growth model is exhausted. The debt accumulated to sustain fake growth through infrastructure nobody needs and real estate nobody can afford is unpayable. The only question is whether the adjustment is slow and managed or fast and catastrophic. Even more alarming, China's official GDP growth numbers are fabricated. Local governments report fake data to meet Beijing's targets. Independent estimates using electricity consumption, freight traffic, and satellite data suggest real growth is half of official claims. China isn't growing at 5%. It's growing at 2% or less. And with that much debt, 2% growth is contraction in real terms. The assumption that China would smoothly transition from manufacturing export powerhouse to high-income developed economy broke completely when the demographic cliff hit and the debt bubble became impossible to deflate. Here's what should keep you awake at night. China isn't just China's problem. They're 30% of global manufacturing, 15% of global trade, the largest trading partner for over 120 countries. When China's economy implodes, it takes global supply chains, commodity prices, and emerging market debt with it. This is the systemic crisis nobody's pricing. Think about that. Before we break down exactly how China accumulated $50 trillion in hidden debt, why the real estate sector is collapsing and can't be saved, what the demographic collapse means for growth sustainability, and why China's crisis triggers global contagion worse than 2008. If you want to understand the most important economic story of the next decade that mainstream media is completely ignoring, hit that subscribe button and turn on notifications. Because what we're revealing will change how you see global economic stability and why betting on China's continued growth is the most dangerous assumption in markets right now. Leave a comment. Can China avoid economic collapse or is it inevitable? Will the Communist Party survive the crisis? And when China's bubble pops, which countries suffer most? Let's start with the debt because that's the foundation of everything that's breaking in China's economy. China's total debt, including government, corporate, and household, is approximately $52 trillion, according to the Institute of International Finance. That's 290% of GDP. For comparison, the United States is at 257%. Japan is at 415%. So China's debt to GDP isn't unprecedented. But here's the difference. The US and Japan are rich countries with reserve currencies and developed financial systems. China is middle income with capital controls and a banking system controlled by the Communist Party. More importantly, the velocity of debt accumulation matters. China's debt to GDP was 150% in 2008. It's 290% now. That's 140 percentage points in 16 years. That's the fastest peacetime debt accumulation in modern economic history. Where did the debt come from? Infrastructure and real estate. After the 2008 global financial crisis, China launched a massive stimulus, 4 trillion yuan, about $600 billion at the time, but the actual spending was much higher because local governments added their own stimulus on top. They built high-speed rail lines connecting cities that didn't need them, airports with no passengers, highways to nowhere, entire cities with no residents, ghost cities. The most famous is Ordos in Inner Mongolia, built for 1 million people, population 70,000. Why build infrastructure nobody needs? Because GDP growth. In China's political system, local officials are promoted based on GDP growth in their region, so they build as much as possible to hit growth targets. Whether the infrastructure is economically useful is irrelevant. And how did they finance this? Debt. Local governments created financing vehicles, LGFVs, which are off-balance sheet entities that borrow money to fund infrastructure projects. The loans are backed by land sales. Sell land to developers, use revenue to pay debt service, borrow more to build more infrastructure, sell more land. A Ponzi scheme. This worked as long as land prices kept rising. Developers bought land from local governments at higher and higher prices because they could sell apartments to Chinese households at higher and higher prices. Households bought apartments as investments because property values always went up, until they didn't. In 2021, the real estate bubble started deflating, and it's still deflating. Home prices are down 20 to 30% in most cities, some areas down 50%. Developers are defaulting. Evergrande, the largest property developer, defaulted on $300 billion in debt. Country Garden, the second largest, is also in default. And here's the systemic problem. Real estate represents 30% of China's GDP when you include construction, materials, furniture, appliances, all the related industries. If real estate collapses, 30% of the economy collapses. Local governments depend on land sales for 40% of their revenue. If developers can't buy land, local government revenue collapses. And if local government revenue collapses, they can't service the debt in their financing vehicles. Default cascades. The central government in Beijing knows this. They've been trying to manage the deflation slowly, providing liquidity to banks, allowing some developers to fail but not all, preventing fire sales of property. But they can't stop the deflation without reinflating the bubble. And reinflating the bubble just makes the eventual crash bigger. This is the no-win scenario. Let the bubble deflate, take the economic pain now, possibly trigger social unrest, or reinflate the bubble, delay the crisis, make it worse when it inevitably hits. So far, they're choosing slow deflation, but it's not clear they can control it, because once expectations shift from prices always rising to prices always falling, the bubble pops regardless of government intervention. Now let's talk about demographics, because this is the other half of China's terminal problem. China's population peaked in 2022 at 1.42 billion. It's now declining. The working age population, 15 to 64 years old, peaked in 2015 and is declining by 5 million per year. By 2050, China will have lost 200 million working-age people. That's the equivalent of losing the entire workforce of Brazil and Mexico combined, and the replacement rate is catastrophic. China's fertility rate is 1.09 children per woman. You need 2.1 for population stability. They're at half replacement rate, and it's still falling. Why? Cost of living. Housing is unaffordable. Education is expensive. Childcare is scarce. Young people can't afford to have children even if they wanted to. And culturally, the one-child policy that was in place from 1980 to 2015 changed expectations. An entire generation grew up as single children. They don't want large families. Even with the policy removed, fertility stayed low. This is the demographic trap. Once fertility falls below replacement for a generation, it's extremely difficult to reverse. You'd need massive family subsidies, cultural shifts, and decades of policy focus. And China is doing none of that effectively. What does demographic decline mean economically? Fewer workers means lower growth. An aging population means higher healthcare and pension costs. The dependency ratio, the number of retirees per worker, is exploding. In 2020, there were 5 workers for every retiree in China. By 2040, it will be 2 workers per retiree. Imagine supporting your own family and also financially supporting half a retiree's pension and healthcare. That's the math. And China doesn't have the social safety net to handle this. Pensions are underfunded. Healthcare is limited. Rural elderly have almost no support. The assumption was families would care for elderly parents, but families are smaller and geographically dispersed now. This is why China's growth model is terminal. You can't grow an economy with a shrinking workforce and exploding dependency ratios. You can fake it for a few years with debt-fueled investment, but eventually, the math catches up. Japan proved this. Their working-age population peaked in 1995. Growth has been near zero for 30 years, and Japan was rich when it happened. China is trying to grow rich while the population shrinks. It doesn't work. Now let's talk about youth unemployment because it's a political crisis, not just economic. China's official youth unemployment rate hit 21% in June 2023. Then they stopped publishing the data. When a government stops publishing data, it means the data is worse than they're willing to admit. Independent estimates put youth unemployment at 30 to 40%. That's Great Depression levels. And these aren't uneducated rural youth. These are college graduates who were promised that education leads to prosperity. Why is youth unemployment so high? Because the economy isn't creating enough high-skilled jobs. The growth model based on infrastructure and manufacturing doesn't need millions of college graduates. It needs construction workers and factory workers. But China pushed higher education enrollment massively in the 2000s. College enrollment went from 1 million per year in 1998 to 11 million per year in 2024. They created an educated workforce, but not an economy that needs that workforce. So you have millions of young people with degrees working in delivery, food service, retail, jobs that don't require college. They're underemployed and angry, and this creates political risk. The Communist Party's legitimacy is based on delivering economic growth and rising living standards. If an entire generation of young people faces unemployment and downward mobility, the social contract breaks. This is why China is so focused on social control, surveillance, censorship, social credit scores. They know economic failure could trigger political instability, so they're preemptively controlling information and monitoring dissent. But you can't surveil your way out of structural economic failure. Eventually, discontent finds an outlet. Now let's talk about the manufacturing overcapacity problem because this is what's driving trade wars with the West. China invested trillions in manufacturing capacity across every sector: steel, aluminum, solar panels, EVs, batteries, semiconductors. The strategy was to dominate global supply chains through scale and subsidies. And it worked. China produces 60% of global steel, 70% of solar panels, 60% of EVs. They're the factory of the world. But here's the problem. Domestic demand isn't absorbing this production. The real estate collapse killed demand for steel and cement. Household consumption is weak because people are scared about the economy. So all this production has to be exported. China is flooding global markets with cheap goods. Steel prices are at 10-year lows because Chinese steel is dumping globally. Solar panel prices collapsed. EV prices in Europe and Southeast Asia are under pressure from Chinese competition. This is creating political backlash. The United States imposed tariffs on Chinese EVs, solar panels, and steel. Europe is investigating Chinese EV subsidies. Emerging markets are complaining about deindustrialization from Chinese imports, and China can't stop exporting because if factories shut down, unemployment explodes. So they keep producing, keep exporting, keep subsidizing, which makes the trade wars worse. This is the overcapacity trap. Build too much capacity based on optimistic demand projections. Demand doesn't materialize. You're stuck with factories that need to run to avoid mass layoffs, so you export at a loss just to keep people employed. It's not sustainable, but shutting down capacity isn't politically viable. So they continue until external markets impose barriers or the subsidies bankrupt the government. Now let's talk about capital flight because this is the indicator that wealthy Chinese have lost confidence in their own economy. Despite strict capital controls, hundreds of billions of dollars leave China annually through various channels. Real estate purchases overseas, moving money through Hong Kong, cryptocurrency, fake invoicing and trade, underground banking. Why are wealthy Chinese moving money out? Because they don't trust the government, they don't trust the currency, and they see the economic crisis coming. If you're a Chinese billionaire or millionaire, you know that the Communist Party can confiscate wealth at any time. You know that the currency could be devalued. You know that the real estate you own in China could become worthless if the bubble fully pops, so you move assets offshore. Buy property in Vancouver, Sydney, London, New York. Get your children educated abroad. Establish foreign residency. Prepare for the worst. This capital flight weakens the financial system. It drains foreign exchange reserves. It signals to everyone else that insiders think the situation is bad. China responds with tighter capital controls, limits on foreign currency purchases, restrictions on money transfers, crackdowns on underground banking. But capital always finds a way out when people are motivated. This is a vote of no confidence in China's economy by the people who know it best. and it's accelerating. Now let's talk about what happens when China's economy actually collapses. Not a slowdown, a collapse. Debt defaults cascading, banks failing, unemployment spiking, social unrest. Scenario 1. Managed decline. Beijing uses its authoritarian control to manage the crisis slowly. Defaults are restructured, banks are recapitalized by the state, growth slows to zero but doesn't go negative. Social control prevents unrest. This is the best case scenario. It looks like Japan's lost decades but with more repression. Scenario 2. Hard landing. The real estate collapse accelerates. Local governments default en masse. Banks face solvency crisis. Capital flight explodes. The yuan devalues sharply. Inflation spikes. Unemployment hits 20%. The Communist Party faces legitimacy crisis. Possible internal political conflict. This is the high probability scenario if current trajectory continues. Scenario 3. Collapse with fragmentation. Economic crisis triggers political crisis. Regions with strong economies like Guangdong or Zhejiang refuse to bail out poor interior provinces. The central government's control weakens. China fragments economically, if not politically. This is the nightmare scenario, but not impossible given regional disparities. For the rest of the world, all three scenarios are bad. China is 30% of global manufacturing. If China collapses, supply chains break. Companies can't get components. Prices spike for everything. China is the largest importer of commodities. Oil, copper, iron ore, soybeans. If Chinese demand collapses, commodity prices collapse. Australia, Brazil, Chile, all commodity exporters go into recession. China holds over $3 trillion in foreign exchange reserves. If they're forced to liquidate, they sell US treasuries, European bonds, other assets. That pushes yields up globally. Financing costs rise, debt crises spread. China is the largest trading partner for over 120 countries. If they can't buy imports, those countries lose export markets. Emerging market debt, often denominated in dollars, becomes unsustainable. This is global contagion, not isolated to China. The 2008 crisis started in US housing and spread globally. A China crisis starts in Chinese real estate and debt, and spreads faster and wider because China is more integrated into global trade than the US was. Europe is particularly vulnerable. Germany's economy depends on exports to China. 40% of Volkswagen sales are in China. If China collapses, German manufacturing collapses. Emerging markets are vulnerable. Countries that borrowed dollars to finance infrastructure are already struggling with debt service. If China stops buying their exports and commodity prices crash, they default. Debt crisis ripples through Africa, Latin America, Southeast Asia. The United States is less directly vulnerable but not immune. Supply chains break. Inflation could spike from supply shocks even as demand falls. Stagflation scenario. Stock markets reprice because corporate earnings depend on global growth. Nobody wins from China's collapse. Everyone loses. The only question is how much. Now, some people argue China can avoid collapse because the government has tools the West doesn't. They control the banks. They control capital flows. They can order banks to extend loans regardless of creditworthiness. They can print when without constraint. And that's true. China can delay the crisis longer than a market economy could. But delay isn't prevention. Japan delayed for 30 years and still hasn't recovered. China is delaying, but the underlying problems, debt and demographics, are getting worse, not better. The longer they delay through zombie lending and capital controls, the bigger the eventual crisis, because the debt keeps growing and the demographics keep deteriorating. There's no policy that solves both problems simultaneously. If they tighten credit to reduce debt, growth collapses and unemployment spikes. If they ease credit to boost growth, debt explodes and the crisis gets bigger. They're trapped, and the trap is tightening. The only question is timing. Does the crisis hit in 2025, 2027, 2030, and does it hit suddenly or gradually? My assessment: gradual crisis starting 2025-2026, accelerating 2027-2028, reaching critical point 2029-2030, not a single collapse day, but a multi-year deterioration that everyone can see happening, but nobody can stop. Real estate continues deflating. Local governments default in waves. Banks face increasing bad loans. Central government uses state resources to bail out systemically important entities, but lets others fail. Unemployment rises. Social control intensifies. Capital flight accelerates despite controls. UN weakens. Inflation rises. Living standards decline. By 2030, it's clear China's growth miracle is over. The question then becomes whether the Communist Party survives the transition, and that depends on whether they can maintain control while delivering economic failure. History suggests authoritarian regimes are brittle. They can maintain control during good times, but during sustained economic crisis, legitimacy breaks down. Internal party conflicts emerge. Regional tensions rise. Control fractures. I'm not predicting revolution, but I am predicting the end of the China growth story that's driven global markets for 40 years. And the end of that story is the most important economic event of the next decade. If this breakdown of China's 50 trillion in hidden debt, why the real estate collapse is terminal, what demographic decline means for growth, and why China's crisis triggers global contagion changed how you see the world's second largest economy, hit that like button and subscribe. We're tracking every data point of China's unraveling, every developer default, every capital control tightening, every sign the crisis is accelerating. Leave a comment. Can China avoid economic collapse, or is it inevitable? Will the Communist Party survive? When China's bubble pops, which countries suffer most? Share this with anyone still betting on China's continued growth. After this, they'll understand why China's economy isn't growing. It's a $50 trillion Ponzi scheme approaching terminal failure, and why that matters for every portfolio, every supply chain, and every government on Earth.